Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, May 17th, 2019. If you caught today's midday update video, there's not a whole lot to add. I'll just kind of recap the levels, show you what happened. We did have a nice reversal today, but again, nothing really surprising based on what's gone on lately, rips and dips, and today was options expiration day as well, so that adds to the volatility. But let's just recap the levels. We'll take a look at the 60-minute charts here in a second. The big levels to watch, I think, are SPY roughly 289. That was my uppermost bounce target, which we hit yesterday, reversed. We have a downtrend line that may come into play here. I had it drawn as a price channel on the 60-minute chart, and you could see that here again. So we had this sort of a downtrend here in SPY that we could produce a reaction there, but like I said, it's worth mentioning, but I really think the big levels, to keep it very simple, and it could be noise between then here, is about 289.21 or 289, yesterday's highs and Monday's lows. Anything in between there we could grind. Now, we did, since the week's over, let me talk on that real quick. We certainly had some more significant developments on the longer term, or I should say the more significant weekly charts. Let's go to those real quick. Okay, here's the S&P 500. And again, this is slow motion stuff. This is the slow roll, but like I said, I think the damage has already been done. It's just a supersized bull market, as I refer this to, thanks to all the central bank intervention, where they've supersized the bull market. So the rips and dips are going to be supersized, and if this was just a kickback rally, then it was a big one, but really not at all out of line with the scope of this correction. I've covered that in other videos. We went back to the 2000 market top, which is really the only market top we can compare in history, at least in modern history, is the dot-com bubble in the super bull market, which was about the same length and in scope as this one that was about a decade-long bull market leading up to March 2000. And again, that kickback rally, particularly in the NASDAQ composite, was even much larger than the one we just had now in percentage terms. So just trying to put things in perspective. And so there's the bigger picture. Let's take this in a little tighter. You can see all the divergence. Let's come into the weekly chart here. So here's our weekly chart, and the point I wanted to make here is that last week I pointed out we had the rejection off the back test of the trend line, the bull market trend line. I was just showing you that trend line came off the March 2009 lows, and a pretty impulsive rejection, which is what you want to see. Otherwise, when you get a back test, if they're green candles and you don't have a rejection, well, the thing is you can keep back testing for a while, even if it's going to roll over. Sometimes you back test and you never roll over, you get back above the trend line. But that's not what happened. As of here, we kissed it last week before last, back tested. We put in a big red candle last week, almost a doji type candle. But this week we followed up to the downside. We closed below last week's closed. Now we're still dancing on pretty significant support. That's why I'm harping on that 281 level. Like I said, it's anybody's game here. The technicals, to me, still clearly indicate more downside, that we're looking at a major top. But I will say, sometimes the technicals, don't play out, or at least the way I'm reading them. I blame myself, not manipulation in the markets or anything else. If I, don't read the tea leaves right, don't read the charts correctly, then I miss something. That's really all there is to it. So right now, that's a big level to me, that 281-ish level. We had a lot of reactions there before, and we closed right about on it. So it's still anybody's game. I laid out a scenario that maybe we come back in here, test that level, and then continue on to new highs. Anything is possible. I mean, you can sit here, we could back test again, and I talked about that. Should the markets happen to push up here in the next couple of weeks to months, there's still a potential for another high, but I won't be chasing that high, just like I didn't chase this new high, because of the divergences intact and everything I'm seeing on the weekly charts. Now, if the daily charts start to firm up and tell me, hey, maybe it is a good time to go, get back into index longs. Until then, like I said, the markets are only one small thing. If you're a YouTube subscriber, all you hear me talk about is the stock market, because that's general market analysis, dime a dozen. I include that on the public channel. 90% of what I trade is not the stock market. It's individual stocks, sectors, ETFs, commodities, futures, other things that are not part of the broad market. So like I said, if this market wants to kick back up here, but if it's still showing a lot of red flags as it does so, if it goes to make new highs, I don't necessarily have to be long, and I don't have to be fighting it. I'll just focus on other things, and I'll like I have been doing for weeks now. I'll continue to provide my thoughts on it and let you guys decide what to do. So that's where we're at. To make it very clear and simple, so far this is just a correction back to a pretty well defined support level. If that support level goes, if we're looking at a red candle next week that is well below the, let's just say 280 level on SPY, closes solidly below it, there's going to be all kinds of support levels that come into play. This is a 40-week moving average right here, the red line, which is the same as the 200-day. I'm sure there'll be buyers that want to step into there. But as I said, the nature of this correction, if we continue to correct, it'll provide me some insight as to whether this is just a correction and a good buying op for a bounce, maybe even to bounce up to game that scenario for another back test. Depending on what I see at this point next week, because we haven't given up 281 yet. But if we go through 281 like it's not even there next week, smash through the 200-day, 40-week moving average, close a week down below it, get a bearish crossover here on the weekly PPO. I mean, look at that. How many times do we get that? That's not very common. If you try to short and go long, bullish and bearish crossovers in a 60-minute chart or 15, you're going to get whipped to pieces. But when you look at this, this is a weekly chart here. And so when that blue line crosses down below the white line, that's the fast line, the white line, or the signal line. The white line's a signal line. The blue line's your PPO line. We had a cross there, bearish cross. That gave us that and that. We didn't really stop correcting to right here. We had a bullish cross right here, so get long. We had a bearish cross right here early on. So it's pretty darn good signal. So that's something you want to keep an eye on right there as well. And again, to me, it's everything. It's not just what I'm talking about here. It's what I've talked about for weeks and months. Breadth deterioration, fewer and fewer stocks lifting the market, divergences. Certain things in the economy that I'm watching, economic indicators and things like that, that all play into this. So that's it. I don't want to spend too much time on it, but I did want to mention and add to today's midday update, because that was only short-term to intermediate-term stuff. This is longer-term stuff, and as of now, more evidence on the weekly chart, additional bearish evidence, but work to be done. That's I guess what I'm trying to say here. Pretty big level to be taken out. And let's not forget QQQ. This is my preferred trading proxy if I'm going to trade the indexes. This is the one I like to trade via futures or QQQ derivatives, you know, the ETFs, whatever, depending on which account I'm trading them in. Here's a nice trend line off the mid-2015 lows. Broken, never looked back, big correction. Looks like nothing but a kickback rally that brought us just, you know, roughly an equal high, slightly new marginal new high, which we failed. So lot on this chart, this weekly chart. So everything similar to the SPY chart I just showed you on the weekly. We'll look at that PPO pending bearish crossover. Not even close yet, at least in the distant differential between the two lines. But here's the thing, and that's the other thing that I mentioned earlier. The nature of this pullback, if it continues, that is, if we start to see it pick up downside momentum and really the selling accelerates and we get a really big candle. I mean, this is a big red candle right here. This is a big red candle. These two aren't really big. They're red and somewhat impulsive selling. But if you get one of these next week, that can close that gap on that PPO quickly. Give us that bearish crossover, which again, these were golden shorting ups back here and here when we had them before. So those are things to watch for, and like I said, there's just a lot of evidence still pointing to me that this was that we had a major top back in 2018, and that this was just a kickback rally, and with you know, much more downside to come. But like I said, work to be done. Let's go to those levels. Okay, we started out with QQ or SPY on the daily charts. QQQ similar. This is the level, my uppermost bounce target that I had on those 60-minute charts, about 186 or so. Or at least I put this at yesterday's highs. We popped slightly above them there. And then look at that doji type candle there. So now we have this 170. We still have 178. That was Monday's lows. So like I said, let's see what happens next week. We could chop around and grind around in here, whether we break to the upside or downside. And again, you want to see a definitive, impulsive breakout, not just a slight pop and reversal intraday back in there, but solid break and/or close. One or two candlesticks above below will help. So let's watch what happens next week. We could grind down lower, or I'll tell you, if I suspect there's a good chance. This is how corrections work, and I always talk about this. This is why I love shorting stocks. Stocks tend to fall much faster than they rise, and they also tend to trap, especially after a long extended run when bullish sentiment is through the roof. Everybody's bullish, thinking that this was great buying up and the market's going to new highs, and a lot of people got trapped up here. So all I'm trying to say is be on the lookout for the possibility that next week, since we've already run up and hit those max bounce targets and we hit that resistance and failed, we could move sharply down through there. I mean, it could happen in one day. You could wake up Monday and we could gap down. Yeah, it's a big move. I'll say that right now. But again, I showed you some big candles from last fall. That's only about a 2 point, a little better than about 2.75% or so down to that 178 level. So, like I said, that could go possibly in a single day. But again, let's just watch it. We could grind down there as well. I don't know what Monday's going to hold, but I can tell you this, and I already said it. I scaled up, put my last lot. I'm back to full short as of yesterday's highs. Today, I have a little dry powder. I'm not 100% in. Usually not at any time, but that gave me another. There was a nice push back up there again. That was another objective shorting entry, and I feel better about taking those shorts home at the close. So we'll see. And again, it's just one trade. Things start to go up here and get well above those levels, stop out. But like I said, scaling in from here to here on this run up puts, just like the last couple short ops that I had back here in this correction, got the corrections right where they turn, but we didn't hit my max targets in those trades. At least the official trades on the site, they were stopped out for a 2 and I think a 3% loss. We've already, this has already been a 6+% drop. 6.5% or so off the top, and we shorted the day after we officially added that short on QQQ on May 2nd. The market topped on May 1st, so pretty good entry there, and I'm very comfortable with that. The official trade may extend the targets, and I'm talking to members of the site. I'm not going to go over those price targets here. All right, let's look at one or two more things and wrap this up. Okay, here's that chart of the NQ E-mini futures that I posted earlier. It's a 30-minute 10-day chart right here. So you have the highs back here in NQ, and remember I talked about this. We were stair-stepping lower. This was the initial leg down. We hit the lows, which was, again, you're looking at a 60-minute chart, so you're not going to see it here, or a 30-minute chart. But that was support on QQQ on the daily chart. It was my target on NQ from before we even shorted up here. Okay, that was here. This chart was posted back on May 1st. That's the day the S&P and everything else peaked, showing a near-term final target there of 72.75, and then that was hit just on Monday, and so that's the expected rally, the reaction. So we bounced up to about where I figured we would. So far things are playing out. Doesn't mean they will continue to play out. Here's the levels I'm watching. These are levels I actually had on the chart before, 75.42, 43-ish. Sliced through it. Today was kind of choppy trading. But here's a potential trend line and 74.58. So this is what I'd be watching on Monday. This intersecting support at about 74.58 on NQ as well. This is only a potential trend line. I say potential because there's only 2 reactions. This is just me. I don't consider a trend line valid until there's a third reaction, because any 2 points can be connected at random. So if we come down there, and the fact that that potential trend line does come in with that was a former target on the downside, or bounce target, I can't recall what it was now, but means that's an area where the buyers should step in if we get there. I mean, we could gap up Monday. We may never even see these levels. Right now, let me be clear. We're in a near-term uptrend off those lows. And just because we stopped so far, my uppermost target, doesn't mean we can't go through there. It just means so far so good. But this is what we're in now. So we're in this near-term uptrend line that I just drew here, near-term uptrend. And that could very well continue. So like I said in recent videos, if you're bullish and think the market was going to new highs, if you thought that up here and you thought that here and here and here and you were buying, like I said, I don't see why you weren't jumping in with both fists when we hit that level. That was very solid support on QQQ, and I mentioned at the time that's what I'd be doing if I thought the market was going to new highs. I'd be long, and I wouldn't even be concerned right now. Again, if that's just me, and I saw things differently, because this is a 6-7% correction, test of pull back to support, some solid support areas. So again, that's what you want to look for. And here's a potential, if you are long and you're saying, okay, well, Randy, I am long, I do think we're going high, but I don't want to get caught on the wrong side of things here in case things go the other way. Well, that's a level to watch. That's one area you could have a stop somewhat below those intersecting lines. And as I showed you in today's earlier video, if you missed that, let's go back to this chart here. This is what's going on right now, or what has been going on since the bottom here. These blue lines where you see these big surges in volume right here, that's where the market opens. I talked about that before, that that's when the big boys, the starters, step onto the field. I'm referring to the institutions. Why is that? They can't play, and they can't maneuver in the after-hour session. They can't trade futures at 10 o'clock on a Thursday night or 3 in the morning. There's not enough liquidity. In fact, if you don't believe me on that, I mean, that's just always been the case, generally speaking, but it's also been drying up. You can Google, just throw in terms like liquidity drying up, going down, stock index futures. You'll see it here. These are all recently dated articles. Thinning liquidity in key futures market, worries of markets. This is a Wall Street Journal article. It came out recently. And you can show here, number of contracts being quoted. This is the ES. You can see it's drying up. And a lot of traders are concerned about that. Now, the takeaway from this is it can cause, this is where mini crashes, that's what they're concerned about. When liquidity dries up, it can cause very sharp markets. If there's some catalyst, whether it's technically driven, for example, a break of those levels that I'm showing you, the recent lows, or it's one of these silly tweets that keep coming out of Washington or something else, that can spark a sharp drop. And let me tell you this, sharp drops, and I'm talking mini crashes, flash crashes. Again, I've said this before, don't worry, we're not going to have 1987 again, a 22 or 3% drop in one day, because it can't happen anymore. There are circuit breakers that were implemented since then that will prevent the market from dropping over 20% in a day. However, you can get some mini crashes and flash crashes. We had them before, and they don't come from this kind of healthy trending market. They usually start after you get a shot across the bow, an initial correction, volatility starts to spike. That's where those big drops come. So I just wanted to say that all that's there, and at the end of the day, the takeaway might be, hey, if you're risk adverse, lighten up. You don't have to be in the markets. You don't have to have a full position. You can hedge. I always speak to the benefits of asset allocation. Treasury bonds that were big chunk of my 401k type money. All that stuff is put right now. Safe money. There are other assets out there, and of course cash. People forget cash. They think they have to be in something. Randy, where can I put my money? The stock market's not safe. Bonds aren't paying squat. There's nothing wrong. There's a lot of money market accounts now paying north of 2%. Short-term CDs, treasuries, things like that. Those are always options. If you're risk adverse and you want to just kind of stand aside till the outlook looks better to get back in. Okay, back on task here, just real quick again. So I showed you that where you see the volume surges, these are the opening. This is where the opening bell at 9:30 a.m. starts regular session trading, and that's where institutions that are trading billions of dollars of capital, they can then come in and buy, and that's what they've been doing since the bottom. They were doing it back here too. They were stepping in right at the open. We've seen some sharp ramps at the open. Like I said this morning, this one was faded, but not back beyond the point where the market opened right about here. Again, you'll see right where the biggest bars start. That's usually the opening trade right there, the big bars. So that was working. It worked great. What was that on Thursday? Big rally. The market opened and futures exploded up. But guess what? They faded it back now, right back again. Overnight they had faded it back to that point, so far so good, but now look where they closed today. What happened is there's a little bit of a change of character. It's too early to call it a trend, but you know, an uptrend, as I always say, is a series of security making a series of higher highs and higher lows. Let's draw it this way. I'll try to draw this out for you. And as you can see, if you go to the right, today we didn't make a higher high, so we were stair stepping up. We came back down, but we never, that was still a higher low right here. So the uptrend was intact. We're moving up, and boom. So we equaled the low, but we failed the high right there. So this is, look, it's not an all-in, get out of the market, red flag. The uptrend, if you just kind of take a step back and look at it this way, the near-term uptrend is still intact, but it is a little bit in jeopardy here. That buying was met with equal selling. In fact, they took it all the way and faded that entire rip. And again, this was from the open today. If you were trading, watching a 1 minute chart, you saw it. I know there were a lot of comments in the trading room. What's going on? It's just, again, we've seen that lately. That's where institutions are stepping in. But what's happened is that buying that they're doing is getting absorbed by sellers. There's more sellers right now glad to sell into the buying, and so maybe this is a start now of a downtrend. It plays into what my scenario where I think we're going based on the 60-minute charts and the daily charts. So we'll see. So to make it very clear, near term now, very near term, I already gave you the levels on the daily chart, but near term, let's watch these lows from today. My guess, if we're going to take them out, the market's kind of cruel to longs. It likes to trap them in there. It also likes to deny shorts and objective entry. My guess is we'll gap down. If we're going to take it down on Monday, we probably won't open up and then move down. That would almost make it too easy. It would allow a lot of stops to be placed there for longs and be exited, you know, at a good price, and allow shorts to jump in. That's kind of the way I think it'll happen. And if we go up, then you want to see yesterday's high taken out, not today's high, because that was our previous reaction high. So these are the big levels, not big, but just intraday kind of near-term stuff. This is just a 30-minute chart. I'm kind of getting granular right now, getting down to the intraday charts. So that's what I'll be watching next week. And as we before we wrap it up here, the only other thing I wanted to mention, I meant to include this yesterday and I forgot to, and then again today and I forgot again. Nice to note, if you guys use, any of you that use Fibonacci retracements, here's the move off the highs right there. Those were the all-time highs in QQQ. There's a recent low. I put up Fibonacci retracements. You can see them to the left of the chart. Look at that, almost a perfect tag right here. That's 61.8. And so, as I mentioned before, these are the levels I like to keep up. They, if this is just a kickback rally, counter trend rally, and a larger trend, it's quite common to see counter trend rallies end anywhere from that 38.2%. 50% or 61.8, so that's the range. And like I said, it also meshed with my uppermost bounce target based on other analysis that I had, but it just helps to confirm that was a a pretty impulsive rejection off the 61.8 fib. And not only QQQ, but here's your SPY, same story, high to low, boom, 61.8% fib to the button. And so now from here, this market either needs to turn up and start to take out those levels, those recent highs right there, to firm up the bullish case. Nice little looking V bottom here, or we go back down, and who knows, maybe we get a W bottom. We could play around with this all day long. Let's just pick it up Monday, see where we go from there. I've given you the levels to watch, and that's it. It's been Randy Finney with the right side of the chart. Have a great weekend.